Welcome to class number 8 of this course in Law and Finance. The subject of today's video is the Eurozone crisis. And in the Zoom session, we're going to read Habermas's text on the lure of technocracy, which is kind of the upshot of the crisis at the level of governance. And then we're going to discuss the recent PSPP judgment by the German Constitutional Court. Now, here's an overview on part 1 on the Eurozone crisis. I'll first introduce you to the European Monetary Union. And in the second part, I'll say a few words on its legal framework. And that provides the ground for an analysis of this Eurozone sovereign debt crisis and also of the unconventional monetary policy adopted by the European Central Bank, and that is so controversial and the subject of the PSPP case. Why did the governments of the European Union decide at some point to establish a monetary union? Now, the reason is simply that the European Union has a common market, an internal market actually. Article 26 of the Treaty on the Functioning of the European Union provides for that, and it's a market based on fundamental freedoms of movement, that should enable and facilitate really an integration of economic activity within the European Union. That can be a problem if you're operating under different currencies. Why? Well, first of all, transaction costs. Now you have prices denominated in different currencies that might develop in different directions. Now, transaction costs is not such a high hurdle because there's a lot of international commerce with countries using vastly different currencies. You can do some hedges to mitigate your currency risks, but it costs something. Yeah. The second reason is capital misallocation. If you've got different currencies, funds available in one economy that could flow to productive uses in other countries will not flow there because people are afraid of the currency risks, of the exchange rate risks. And the third reason is probably the most important one from a governance perspective. If you've got different currencies, a government or a central bank, if it is allowed to do so, might use its currency in order to gain an unfair competitive advantage. You're manipulating the exchange rate. For example, you're doing purchases or sales of your currency on international currency markets, or you're printing a lot of money and therefore indirectly influencing the exchange rate, and then the products from your country get cheaper. You get an advantage. And that is unfair because that has nothing to do with economic fundamentals. Your products are not better, your infrastructure is not better because of that, but it's just the exchange rate. Yeah, that does the whole music. And that is not very good. It's a hurdle for an integrated internal market. And therefore, once the Bretton Woods system collapsed, which also had provided the monetary background for the early period of the European Union, or then European communities, European leaders thought about systems that would replace Bretton Woods, and they introduced subsequent models. The first was the so-called currency snake that allowed fluctuations of plus minus 2.25%. It didn't really work very well. After that, in the late 1970s, they tried to introduce the European Monetary System 1, and that allowed also fluctuations of 2.25% plus minus, but it had an adjustable band. That means that you could, from time to time refix the overall balance between different currencies, pretty much along the lines of the older Bretton Woods system. And that didn't last very long either. Well, it lasted for over a decade, but in the early 1990s, it came into troubled waters. And why was that the case? Well, 1990, Germany had the reunification. There was a lot of financial needs. So Germany's debt rose immensely. It literally went through the roof. All this money being put on the market, or all the fresh credit, led to an increase in the quantity of money that prompted the Bundesbank to impose high interest rates, which is the thing you should do in order to keep prices stable. If there's a lot of money, there's a risk of inflation. So you have to have a high policy rate in order to reduce the risk of inflation. Now, the problem was that this policy of high interest rates was just the wrong thing for other European countries that were part of this European monetary system, especially France, Italy, and Great Britain, because at the time they found themselves in a recession. Germany also was in a recession, but it had a different financial situation. And this recession, as such, required much lower interest rates. Yeah, because you want to restart the economy again, you want to make it easy for people to get access to credit. That's a problem. If you've got low interest rates and Germany has high interest rates, where does the smart money go? It goes to the high interest rate country. It went all to Germany and created a lot of trouble at home. And that led to the collapse of the European monetary system. The other countries were no longer willing to maintain that and, to expose themselves to the impact of the Bundesbank's high interest rates. That was a very unsatisfactory situation, and that created momentum for the idea of a monetary union that had been around in government circles for quite a while. The advantage of a monetary union would be that you have only one single interest rate. So there would not be this interest rate differential that would lead to capital flights based on purely financial conditions and not on economic fundamentals. It would also lower transaction costs, but as I said, transaction costs is only one factor among many, and it would avoid exchange rate fluctuations. And also it would make it impossible to use the exchange rate for manipulations. However, there's no free lunch, so there are also disadvantages to monetary union. I think more than 10 years into the Eurozone crisis, that almost goes without saying. What are these risks? Countries cannot devalue their currency in case of current account deficits. What does that mean? If you're buying more products abroad than you're selling to other countries, you need to make up for the difference by taking in loans. Normally, this process of an imbalanced current account is put back into balance through the exchange rate. If you're buying more than you sell, your own currency goes down in value as opposed to currencies of jurisdictions for which you buy. That gives you a competitive advantage. So in the long run, you will sell more. If you don't have an exchange rate, that mechanism is not available any longer. The only thing you can do to regain competitiveness in a situation where you're not so competitive and therefore don't sell as much to other countries as you're purchasing from them, the only way of regaining competitiveness is by so-called internal devaluation. And that basically means austerity. Lower wages, lower public investments, therefore lower taxes, etc. And that is a risky policy because this kind of internal devaluation might lead to a downward spiral. You might have to save money and to lower wages in a situation where your economy needs more demand. Yeah, it's anti-Keynesian, so to say. Yeah. Another problematic consequence of a monetary union is that this common interest rate is just the average. So it might be, or it will almost by necessity be too high or too low for some. Yeah, there will be some areas where you would need a higher interest rate. And there are other areas where you would need a lower interest rate because there's almost no economic activity. But it's just one interest rate, one average interest rate. And that might lead to capital misallocations. So you can only safely run a currency union if you've got mechanisms that set off these effects. So basically, if you've got a public scheme of redistribution that makes up for the imbalances, that ensures that parts of your union which have a negative current account don't have to save themselves to death. And that ensures that misallocations of private funds are set off by allocations of public funds. Yeah, basically you need a redistributive scheme based on common taxes where the money is put where the market doesn't bring the money yet. Yeah, so within one state, this is the task of government, to levy taxes and to use the taxes productively, especially in regions where it is most needed. You don't need to invest in boom regions because you will only heat up an overheated economy already, but in the not so boomish regions, you need to do a lot. And you need to do the exact same thing at the level of a currency union. Now that brings me to the legal framework. The legal framework consists in two prongs. The first prong is on money. Monetary policy consists, according to Article 119, of a single currency. As I said, there's only one currency and therefore also only one interest rate set by the ESCB Council. The ESCB is the European System of Central Banks. That is kind of the entity comprising the European Central Bank as a separate legal entity and all the national central banks. And it's all of them together at member state level and at union level who are setting the interest rate to ensure that it somehow fits all of them. But there is also a substantive framework for money. They cannot set the interest rate just where they like, but they have to guard price stability. That's the content or the message of Article 127 TFEU. In order to ensure that it will be faithful to their mission and there will be no undue political intervention, Article 130 of the Treaty on Functioning of the European Union provides the entire European system of central banks with independence, institutional independence. And it also makes sure that they should remain independent by prohibiting it to them to engage in monetary financing, i.e. to use the monetary printing press to fund governments. They cannot directly purchase government securities from the government. They can purchase them from commercial banks indirectly. Commercial banks who want to have access to central bank funds, but they cannot, just fund the government by printing money. That's what Article 123 says. So you've got a quite restrictive monetary policy scheme that really reflects the ideas of monetarism and the emphasis on price stability. You might remember what I said on inflation in that regard. Now, the crux is the second prong, chiefly the second prong. Some people will think that the first prong is also problematic, but the second prong is particularly problematic even under the premises of monetarism, this hard money price stability thinking school. Why is it so? Because it does not establish this cushion, this safety valve that I just said is necessary for a monetary union to function properly. By contrast, Article 121 of the Treaty on the Functioning of the European Union only provides for soft mechanisms of coordination of economic policy. So we don't have a common labor market policy. We don't have a common fiscal policy. We only have a broad, soft, non-binding framework in order to ensure a broadly common approach. But there's no harmonization. There are no transfers, so there's no guarantee that business cycles will always be the same. Even though since the beginning of the European communities, and especially since the establishment of the monetary union, there has been a certain adjustment of business cycles. So they're more uniform and more coherent now than they were before. But still there can be divergencies among countries, and there are very few legal means to make up for them. By contrast, Article 125 provides that governments may not assume the debts of other member states. So each member state has to be self-reliant, nor may the European Union take over the debt of its members. Article 126 says, we recognize that this is a risky situation, that governments don't have that many safety valves. Therefore, it's important that each government remains healthy, and that means they shouldn't have too much debt upfront. And for that reason, the Article 126 is kind of a system for the prevention of excessive deficits and excessive debt. It puts a limit at budget deficits at 3% annually and a cap on the overall debt of 60% of GDP. And it provides for certain sanctions like blue letters or even fines. But honestly, it has never been really implemented. Already in 2003, the first time when France and Germany should have gotten a blue letter from Brussels, that was prevented at a political level because these rules provide a lot of political leeway to interfere. All this seems to be a rather fragile and dangerous, risky system, and indeed it was. And that's the background of the Eurozone financial crisis, of the Eurozone sovereign debt crisis that unfolded in the wake of the great financial crisis. Now, the underlying problem was that some members of the European Union have been very competitive. The euro was too weak for them. Germany is one of them. For example, it has, at least in recent years, benefited enormously from a cheap euro, which more or less was a huge export subsidy for it. For other states, it's the exact contrary. Yeah, they're not so competitive, but they have a high value currency, and that sort of kills their competitive advantage. And they have to make up for their current account deficit by borrowing money from abroad, and they're overborrowing. That became a problem in the great financial crisis because that put a lot of strain on government funds. Governments need to bail out commercial banks. Governments faced a recession, which comes with lower tax revenue, and they even had to provide, in that situation, fiscal stimulus to their economies. And that was just too much for budgets of some member states, and it led to the collapse of trust in their capacity to repay their debts in full. And that is the cause of the Eurozone financial crisis. So one country after the other that found itself in that situation was troubled and faced interest rates for its sovereign debt that it could no longer shoulder. It began with Greece already in 2009, and then it became virulent in 2010. And by over the years, the European Union adopted a number of measures to address this crisis. And that led to a significant rebuilding of the European Union and especially of the Eurozone. Now, the first of these measures is a mechanism for short-term rescue measures. It's the so-called European Stability Mechanism. It functions a little bit like the International Monetary Fund. Countries in a debt crisis can go there and get funds and get an intermediary financing in case of a crisis, if the financial strain just becomes too much. Of course, that is somehow punitive because it requires austerity of them. So it requires them to adopt a program of policy reform, so-called structural adjustment program, and the conditions which they have to subscribe to, that's negotiated between the Commission and the country, and the conditions they might subscribe to might be more or less beneficial. Let's put it like that. And some of these conditions that were actually imposed in the crisis were quite harsh and led to a lot of social problems. I think that is something that we already saw in the ADD and Koufaki case. This European Stability Mechanism also created a number of legal problems. That was the subject of the Pringle case that we studied for the last class, the no bailout rule. The second prong of these policy changes adopted in the aftermath of the Eurozone debt crisis are of a more longer term perspective. They concern changes to the Stability and Growth Pact, the overall framework that is meant to keep member state finances stable. The European Union adopted a number of pacts. The first one is the six-pack, that's 6 regulations and directives adopted in 2011, and their function was to make the Stability and Growth Pact stricter. So the idea was that sanctions should come earlier and there should be more incisive, and there should also be a procedure for the correction of macroeconomic imbalances. So countries should be held to fix their problems of undercompetitiveness or overcompetitiveness at the right time. That wasn't really sufficient, so yet another pact was needed a year later, the two-pack that put in place a tighter system for the surveillance of countries' economic and financial situation, especially a sort of centralized budget review where countries have to send their draft budgets to the European Commission, and the European Commission gives them the okay or not, and they have to negotiate with them even before they adopt it in the domestic parliament. That's the so-called European semester. Very controversial, but its impact and its effect is really up for grabs. And another measure also adopted in 2012 was the Fiscal Compact. That's an international treaty that obliges countries to put in place strict deficit breaks in their national constitutions. Now, all these measures were aimed at, reinvigorating the original design of the European Monetary Union, namely the idea that member states should be responsible for their own financial situation. But to be quite honest, now with some distance, looking back at that with a distance of a couple of years, it became clear that nothing much has changed, that these rules are pretty much unenforceable, because in every case, they would almost by necessity go with quite some hardship from a political but also from a social point of view. So governments would be forced to adopt very restrictive budgetary policies. And today, in a situation where we just came out of or still are in a major pandemic, and where there is a need to face the climate crisis, and where there's a need to moderate a transition to a digital economy, that looks like a very short-sighted strategy, because it makes the governments save money. And at some point, you've saved yourself to death. You're losing your future. So if I may allow myself that comment, I think that this whole set of fixes to the Stability and Growth Pact was rooted in the past much more than in the future. That cannot be said about the next prong, about the banking union. The banking union was set up to break the vicious circle between government funds, or between government budgets and commercial banks. If commercial banks get into a deep crisis, that should not have an impact on the government budget, or at least not as heavily as it had one when governments need to serially bail out banks. And to solve that, it was decided that governments should get funds for bailing out their banks from the European stability mechanism. But in exchange for that, supervision of banks, at least of systemically important institutions, was shifted from the domestic to the European level. So the deal was somehow, we pay for problems in your financial markets, for the deficit and for the necessary bailouts of your banks, but you have to let us, the European Union, supervise them. That's the background of the single supervisory mechanism, which supervises the most important banks in each jurisdiction and has done so since 2014, giving a lot of additional competencies to the European Central Bank, which hosts the single supervisory mechanism. Independent of the European Central Bank is the single resolution mechanism. So that is basically the bailout institution at the European level. And the last component of this banking union is a common deposit guarantee scheme. So a common scheme that, or actually a common fund that will pay the depositors in case their bank goes bankrupt. Because depositors, people that just bring their money to the bank, are insured up to 100,000 euros against the bankruptcy of their bank. And if you make that scheme Europe-wide, it will be much more resilient, and you will not have a situation where only one country's scheme goes bust, and then it needs to tap the European stability mechanism. But there will be a lot of solidarity. So one system will support each other system if all the funds are pooled. And one could say that one last final prong of the post-crisis measures concerns investments, both private investments and public investments. For a number of years, there has been a plan to increase the integration of capital markets. Not so much has happened in that respect. A few legal acts were adopted, but capital markets are still pretty much a thing for each member state. So there's still divisions in the capital markets. They're still somehow fragmented. It could be that this now changes with the crypto regulation that the European Union has proposed. We will talk about that in detail in our next session. And there are also plans to finally, at least in a limited way, enable common fiscal policies or enable public investments funded by the EU. You may know about the Next Generation EU fund set up in reaction to the COVID-19 crisis. As of today, all member states have ratified the necessary legal instruments, the necessary financial framework. And the big question will be whether the European Union manages to levy common taxes or taxes at EU level in order to fund the repayments for this fund. The European Union representatives and also national government representatives are adamant at emphasizing that this is a one-off measure. But I suppose now that we're after the COVID crisis, or somehow after the COVID crisis, I guess that the next crisis is just looming around the door. And I think that in case of the next crisis, the European Union will again resort to such measures. And if it has ways of funding that itself at EU level, for example, through carbon taxes or through digital taxes, none of that is an easy walk. But if that is put in place, then the European Union will be much more resilient. It will finally have, at least in a limited way, a distributive capacity, at least for crisis periods where it's really needed. Now, the last set of measures adopted in the crisis aftermath concerns the European Central Bank. The European Central Bank has become a major player as a consequence of this crisis because the fiscal solutions adopted by EU governments turned out to be insufficient to calm down the markets. So when the European Stability Mechanism was set up, market participants thought that conditions were still too harsh for troubled countries, and they still had the same or similar financial risks, and their interest rates didn't really get down. And that created a risk that may have easily spread to other countries. It was often said that Italy would be a crucial tipping point for the European Union for its entire stability if it really became seriously under threat. It never came to that, but if that had happened, that would have been disastrous. And since the fiscal policy response was not enough, at some point the European Central Bank stepped in and said there's a deflationary risk. Now, that is an interesting position to take, and that is the subject of many court cases. But the European Central Bank basically said this is not only a fiscal crisis, but that fiscal crisis has a monetary component. If there's not enough public investments, or if there's not enough trust in the capacity of states to pay back their debts, it will also impact monetary policy. If there's this mistrust, we can put as much money on the market as we will, inflation will not go up. Simply because no one will extend credits, everybody will be afraid of a further worsening of the crisis. And that is the basic rationale under which the European Central Bank, with some variations, justified a series of programs, all of which were meant to intervene in the market and stabilize financial conditions, always with a view at fighting deflation and fighting irrational developments in the market. That began already in 2010 with the Securities Markets Program, some asset purchases, and then a crucial point was reached in 2012 when the interest rates that governments had to pay on their sovereign bonds really reached a new high, and all the mechanisms adopted on the fiscal side didn't really show any impact. Then Mario Draghi, then the president of the European Central Bank, held his famous press conference at which he announced that they would make asset purchases specifically targeted to countries under pressure from the markets, and that they would do whatever it takes. And they will do a lot. That is somehow what he implied. That was the so-called outright monetary transactions program. That measure was orchestrated by a number of other measures. For example, the ECB changed its guidelines on the eligibility of collateral. So they basically said, we are also accepting not so good securities as collateral if banks want to have access to our resources, to our funds, because we just want the market to take the money basically and generate the impression that there will always be liquidity and there is really no fear to invest and to extend credit. National central banks also try to do a lot by extending liquidity to troubled banks, but at some point the ECB prevented that. And things calmed down considerably, or took a new turn, when in 2015 and 2016 the ECB announced and then implemented quantitative easing, a massive asset purchase program where they said, no, we're not only buying assets specifically and in increased quantities in countries that are troubled, but we're overall increasing our balance sheet massively. So we're just increasing the monetary base in order to provide that stability that we think the market is looking for and that is necessary to fight deflation. And they topped up on that even in 2020 when a new program was set up in reaction to the COVID-19 crisis, the so-called PEP, Pandemic Emergency Purchase Program, by which they also said we're going to stabilize the market in these unstable times. That is still pending before the German Constitutional Court. I'm wondering what will come out of that. Now here on this graph, you can see the result of all these policies. You see how the balance sheet of the ECB has been expanded massively since the beginning of the crisis. You see a small spike at the end of 2008 where they purchased a number of instruments, but that is really dwarfed by the later developments, especially in 2012 when they announced these unlimited purchases. Then their balance sheet actually went up, even though they never put in place really this asymmetric outright monetary transactions program. But in general, they increased their monetary base, and that did the job. And then in 2015, 2016, the announcement of quantitative easing really led to a complete change, so that now the balance sheet of the ECB has gone up from $500 billion in 2017 to more than $3 trillion. Inflation hasn't really risen. It shows an interesting disconnect between monetary policy and actual inflation rates, and which shows how indirectly a central bank may only influence market activities. Here is a graph that shows inflation. You can see the dotted line is inflation, that the inflation has remained stable throughout the financial crisis. And while inflation used to be acyclical or anti-cyclical to the development of the unemployment rate, the unemployment rate is the continuous line, sorry for the German description here, we see that this is no longer the case. So inflation is really remaining low and unemployment is doing whatever it wants under these conditions of low inflation, which means that we're overall now really in a different situation. And that is why many people doubt the wisdom of monetary policies or monetary policy ideas of the past. And there's a lot of thinking into what monetary policy should do in our age, especially how it should react to challenges like climate change and digitalization. Some of these challenges pop up in the PSBB case. I'm looking forward to reading this case and also Habermas's analysis of the European sovereign debt crisis with you in our Zoom session. Take care.